Hello, everyone. Thanks for thanks for tuning in. Welcome to our session today on how to value a startup. Man, I wish the answer to this question is very simple, but at the same time complicated. And I know that that's something people tend to say when they start these things. But the for most of your companies, the answer to valuation is simple. And yet I think I had to make like 30 slides today to explain why that is, and mostly to convince you, right? I think that founders kind of tend to worry too much about valuation at early stage, and you shouldn't. And that's kind of a little bit of what the session today is about. So we always have a bunch of time for questions. I think my slides are going to run maybe 30 minutes or so, which is going to leave us the rest of our hour for questions. I love to take questions. I have you guys here on Zoom, so thanks for tuning in through there. I have a bunch of people on the YouTube live stream. I always get this question: is there recording? Yes, it's the YouTube live stream. You can go to our Startup Club channel. That's where you'll find it, and it'll be there as long as we don't make a newer version of today's session. Okay, so hey, again, my name is Kaya. I am one of the founders of this company called Slightbean. And for the longest time, it's going to be 13 years now, we've been helping companies navigate this fundraising mess. Like I said, maybe many of you know us because of our YouTube videos. We've been making those for a while. They've gotten a fair share of views. But yeah, now we've kind of centralized all our startup knowledge into this channel that we started last year called the Startup Club. So that's where you want to be for new webinars. We're now doing one every Thursday, and we expect to continue doing that. And for any and all startup knowledge, that's where you want to go. But again, like what we do is we're a platform for founders to navigate fundraising. So inevitably, the question of how much is a company worth comes up a lot. So how do we answer that question? Okay, I think the first thing that we have to get on the same page about on this whole thing is that all companies, or most of the companies that are probably here in this session today, are billion-dollar ideas, right? I got this question from Jordan. It's just, hey, like this is an untapped opportunity. How would you value a hardware company that is going to this big market? Well, pretty much if every idea should be that, right? Pretty much every idea should be $1 billion idea if you want to pursue venture capital, right? So I see a lot of founders kind of like digging into it. No. But our idea is $1 billion. So, dude, that's every other startup is $1 billion idea, right? That's not what makes your company more or less valuable, because every tech company or every tech startup is kind of going on that path. So how do you value, right? So back again, how do you value a startup today? So let's kind of zoom out for a bit and think of, how did we come at this word, right? Valuation, right? Because that makes things hard. But in the end, what us founders tend to be thinking about when we're talking about valuations is something simple. We're always thinking percentages, right? We're always kind of thinking, oh, how much I'm gonna retain in this business, right? How much ownership in my company am I gonna have? Right. And that ownership kind of connects also to stuff like not getting fired, right? You have these horror stories, Social Network, and all these cases, Hollywood stories by all means, where the founder gets fired because they lost control of the company, right? They don't have 51% anymore, so they get fired from their business. And that's a real concern by a lot of founders. Salary is another concern, right? Salary and I guess net worth, right? For us, it's like, oh, like if we own more of this company, we will pay ourselves more, or we'll have more money. That's kind of what we're thinking about. And also we imagine, right? We imagine that investors are thinking about stuff like company control, right? We feel that this valuation discussion is also a discussion of control, right? And making sure that the investors don't take our companies away from us, right? And we think that that's their intention. We know that there's ROI involved, like they want to make their money back, but we kind of sometimes forget about that. But anyway, like the bridge between these two push and pull, these two pools, right? From founders what they want, investors what they want, like the bridge between these two. Well, that's what the valuation is for. But in order to kind of think or to decide what that valuation is, I think we have to sort out what these priorities are, because it's not the ones I just listed here. I think that VC-backed startups are not about control. Somebody said, I see somebody talking about Mr. Wonderful. Shark Tank is not a VC back, a VC show per se, not a tech VC by any means. These guys invest in like mostly retail products, if you think about it. And tech startups work very different. And I want to kind of paint those two pictures, right? Let's imagine this company. It's company one in our scenario. We're here, right? We're at the very beginning of this company journey, and we've established that this company needs to raise funding. We need money to get to where we want to go. And where do we want to go in company one? We want success. We probably want profits, right? And that company, and by generating success and profits, and where we want to be after all this time is we're thinking again of the stuff that I mentioned earlier, right? We're thinking of percentages. We're thinking that we don't want to get fired from this company that we built. We want to make sure that we increase our salary and that we end up with a good net worth out of this. But that's kind of what we're thinking about this company. And company one is not too different from a Shark Tank company, genuinely, right? Like a company that goes to Shark Tank looks to raise one round of funding from these guys, and that's it, right? After that, success, profits, dividends, all this other stuff, right? And that's the push and pull, but that's not how a tech startup works. Tech startup works very different. And that's company two, right? So let's say that tech startup works. We're in the same position, right? We're starting this tech company, and what we are aiming for is yes, success, profits, kind of too, yeah. But in order to get that, we understand that tech startups can't be profitable for a while because tech startups need to grow really fast, right? So funding for tech startup, there's a lot of funding happening for this tech startup. They're going to need to raise a lot of rounds of funding. It's not just one; it's a bunch of rounds of funding. And again, success for a tech company, for a VC-backed company, is not necessarily in percentages or not getting fired or salary. It's in a payout, and the payout for us in tech is an exit or an IPO. That's the only exit. There is no, hey, I'll just keep running this business and collecting the profits. That's not the world where tech startups operate. And the difference, and I think a lot of founders kind of get confused or mix these two together because it's honestly not very intuitive to understand them, right? I want to use the example that you guys on the Zoom talked about, which is Shark Tank. Like I think most of Shark Tank companies, if not all of them, are company one, but tech startups are by all means a different sort of beast, right? And we need to understand, and you guys need to understand which company you are. Are you company one or company two? And depending on that, well, what investor are you going for? And once again, what your valuation is. Maybe as simple as I can put it is company two can raise VC money, venture capital, tech, startup money. Company one can't. It can't. It's a different type of investor, completely different type of investor. So I see sometimes companies that are in reality a company one, and they're trying to pretend to be a company two because they think that that's going to unlock VC money for them. Not a great use of time. Again, the reality is that company one operates in a very different world. Most of what I talk about in my videos is company two. So yeah, let's dig a little deeper. I see your question, Dennis, but it's a little long, so I'll revisit it in a sec. Okay, so now hopefully we've established that these two companies, that what we want, right, the objective of the founders and the objective of the investors, in both cases is a payout, right? And the valuation is still the bridge between how much payout we want as founders or as investors, but payout is what matters, right? It's not so much about ownership. It's not so much about who has control. It's about, well, how much money are we gonna get when we sell this thing? That's it. Is it enough to retire, or is it enough to start another company if you still have the stamina for it? But that's what we're negotiating around, right? And I think that okay, payout, but how do we put that in numbers, right? And I'll give you this old but useful example, right? Imagine that you build a $10 million startup. By startup terms, that's a tiny company, but let's say that you do build a $10 million company, you sell it, and because it's a small company, you retained a lot of ownership. You own 40% of this business, so when you sell it, you make $4 million, and that's great. I don't know if you guys watch Succession. There's this line by the there's this line like you'll be the richest poor person or the poorest rich person. I mean, $4 million is a lot of money by any means. It's life-changing money, but most of us like we're not working 16-hour shifts to make $4 million. Poorest rich person. There you go. So what are we going for, right? What's the other case? Well, what if we build a $1 billion startup? What if we build a unicorn, right? That's a $1 billion company. But in order to do that, there's no way in which you build a $1 billion company with a B and still keep 40%, because there's no way, because you'll need to go through so many rounds of funding in order to get there, right? Yeah, $4 million is great to outlay. It's a lot of money. I mean, you can pay a mortgage. I don't know if you can retire on $4 million, but it is a lot of money. I mean, it's not by no means small success, but that's not what we signed up for, most of us, right? But in order to get to that $1 billion valuation, we'll need to go through a bunch of rounds of funding. We'll need to shed a lot of equity. We'll have a small amount of equity at the end of it, but we'll still make 10 times more. And that's kind of the game, right? That's kind of the game that we play. I would rather, yeah, maybe company one here. Company one gives you the pride that this is your business, and that this is your thing, and you have or retain a lot of control and ownership. But I think company two is more exciting because it pays more money. And again, like, I mean, we're excited. I mean, I love building companies and I love working on this, but in the end, money is the answer, is it? Like, money is part of what we do it. And for the investors, it's absolutely the reason why they do it. So, to your question, do we need to build $1 billion companies? No. No, not all companies are $1 billion companies. We don't need to set out to build the company two. We just have to understand that if we are company one, the circumstances are very different, right? The investors are different, the valuations are different. But if we're company two, then that's a very different path, right? And these paths don't necessarily align to each other, in the sense that in company one, there is a world where you retain 40 or 50% of the company. Yeah, because you only go through round of funding, and you are able to retain that. There is a world where you do that. There is no world where in company two you own that much equity, and I have proof of that. These are actual numbers from eShares last year. This is the percentage of equity that all founders combined, not just the CEO, not just the one founder, but the set of founders, 2, 3 founders, the percentage of equity that these founders retained after each round of funding. The black circle is the median, right? So we have the 90th percentile on the right, which is like the best companies, and the 10th percentile on the right, which are the worst fundraisers, if you will. So check it out. The median company by Series A, so this line here, by Series A, all founders combined have 36% of the company. That means that if you're 2 founders and you split the company halfway, at this point, each of you will have 18% of the business. At Series A. At Series D, the median founder will have, the median combined group of founders will have 11.4%, right? So in this case, imagine this is 3 founders. At this point, each of those founders owns something like 4% of the company. That's normal. I'm not saying this because investors are screwing these founders or because I'm criticizing it. This is what it is, right? In the VC world, in the tech startup world, the path to raising all those crazy amounts of money that we see tech companies raise, the path to doing that is equity, and that means that founders will need to shed it. And I understand this. I've gone through rounds of funding, and I understand how those negotiations work. But a lot of founders that are just getting started, they don't, right? They're kind of fighting over the +1, +2%, and you should, by all means, fight for your equity, yeah. But they're kind of operating out of this unattainable standard. That is that it maybe some really, really good fundraisers by Series A. I think this is the top 10% of companies, right? They're able to retain 40%. They're able to retain 60, right? All founders combined. So only give investors 40 by Series A. Again, this is a top 10% of companies out. The top 10%, which are already companies that survive through all of this, right? So it's not just the top 10% of companies. It's really like the top 1% of companies after you write off all the companies that died before they raised their Series A, right? So it's really at really top tier companies. And by Series B, no company do founders have altogether majority ownership, right? This is at Series B. This is already a business that's managed by a group of people, not by a single person. And I think a lot of founders underestimate that, or just don't know how that operates, and that leads to sometimes awkward conversations. But that's what we're here for. Does that surprise you? I'm curious, like if you had any idea about how this worked, or if this is news to you. Shoot me messages in the chat. I'm curious. Okay, let's keep going. Okay, so we've established that valuations, that it's about the payout, not about the ownership. We've established that majority ownership is not something we're going to be able to keep by Series B. Jordan is asking, could they still own majority with 11%? No, because that's just 11%. 90, the other 89 is owned by somebody else. So yeah, so majority ownership is not something that we can fight for, because that's not the way it operates. Ryan, to your question, just because you start taking money doesn't mean that you need to keep taking money. That's true, but that's also kind of this thing with company one and company two, right? Company one usually only needs one round of funding. Company two tends to need more because it's growing really fast and it's funding. And if an investor signs up for company two, what they expect is a payout in 7 years, which means that you'll need to take that money, right? If you get investors and if you sell yourself as company two, and then you figure out, no, we don't need more money, we're just gonna chill and we're gonna become a company one, you're gonna have a bunch of angry investors. Right? You have to decide what type of business you are, and it's hard to change paths halfway. But yeah, again, going back to the slides, like Mark is but this is Meta, right? Mark owns 13% of Meta, but this is an extreme exception. Of course, that's why it gets talked about. Meta is one of a million companies, right? So yeah. Anyway, majority ownership, not something that we can fight for. Mark doesn't have majority ownership. He didn't have 50% of Meta or Facebook probably after Series B or C. He's also almost a solo founder. He got rid of Eduardo, so he didn't have to split that with anybody else, more or less. But yeah. Anyway, so majority ownership is not what we're fighting for, but what we do want to fight for, I guess, is making sure that we share the decision making with smart people, right? We don't want idiots, and sometimes investors are idiots. We don't want idiots making decisions for us, right? So we understand that it's not through majority. It's not that it's not a monarchy where we have 51% and everything that we say goes. That doesn't happen. That's not going to happen, right? But how do we share this decision making with the right people? And then on the other hand, you have that we always think that investors are like scheming to get rid of us, right? But that's not the case. Like, removing a founder from a company is actually a really, really bad idea. It's something that happens in a very extreme scenario where the founder has done some idiotic shit, and in the interest of all the shareholders, right? Not just the founders, but the employees too, right? Maybe that's not the right person to lead the company. So investors, more than removing the founder, right? They just they don't want to lose their money due to some people being idiots, right? And some companies fail because they don't have a great product. That's not one single decision or one single human error. It's just that the company wasn't able to thrive, right? Some companies fail because the market changes, right? How many companies have now failed or are struggling because of AI came in? Nobody could have predicted that AI became what it was going to be so quickly. So it's not anybody's fault, right? I mean, you could try to catch up to what's going on, but it's not any one person's fault, right? What I think that investors what they want to protect themselves is against, again, founders being idiots. Let's take an example of the Uber founder, right? That made this rant and this PR mess that could be a PR mess. Like, what do you do? Well, you have to get rid of this guy for the interest of the business. And it's not, I don't think there's anything wrong with that. So again, the 51% ownership mess is one that people really, really worry about. And I see founders kind of struggling a lot with. I've had conversations plenty where founders say, no, but I won't accept that. I must control 51% of the company. I must control, and I won't do it otherwise. I'm like, dude, good luck with that, right? anyway, but this control, like this decision making, the way you protect yourself is not through valuation. It's not through percentage equity. It's through building a good board of directors. That's a topic for another day. But yeah, the board is really the one that makes the decisions. And if you have smart people on the board, if you respect their decisions when you appointed them, and you're unanimously outvoted on some decision, well, maybe, I mean, consider that, right? I as a, as an employee, right, I wouldn't want to go work at a company where everything is just every final call ends up in one person, right? I would want that person to have, weights and leverages and people that can outrule them, or that, yeah, I think that's fair. I think that's the way most businesses run. But anyway, okay. Let's keep going on. Let's keep talking about valuation. So we've established that these idea of a billion-dollar company, it has to be a company too, right? But how much is it worth? How much is this company worth? Let's get back to valuations. Okay, so we've established that these, that these type company B, company two, they have to go through plenty of rounds of funding, pre-seed, seed, Series A, and so on, and then we're swimming towards this goal of a payout, right? And we know a few things, right? One big disclaimer I always like to make is pre-seed companies are not idea stage companies are not pre-seed companies. If you have an idea, that's not inherently fundable just because it's a good idea, right? Idea comes before pre-seed stage, and pre-seed stage is a stage where you already have a team, where you already have some validation in this idea, where you've had conversations with customers, and where you've validated this idea somehow, maybe some prototypes, right? So idea is not usually fundable. There are some steps between idea and pre-seed, and those steps don't necessarily cost a lot of money because there's no money at idea stage. But yeah, it's not just that an idea is automatically fundable. Between pre-seed and seed, that's when you launch, right? So a seed company is usually a company that has a little bit of revenue, $40,000, $30,000 on revenue. And between seed and Series A, you hit like the $1 million ARR mark, right? So $1 million in annual revenue, right? So about 160K in monthly. But by looking at these milestones, we're starting to see a pattern, which is that before we get to Series A, we don't have a lot of revenue to go with to decide on a valuation, right? You always see valuations kind of being maybe a multiplier, right? So after you have revenue, for example, you could say, well, my company valuation is 5 times my revenue, and that's fair. That'd be a fair valuation. These days, those valuations are probably even higher. Why? Because you have enough revenue to justify that, right? It's between seed and Series A, you already have at least $1 million in annual run rate. You can operate out of a multiplier, and you're raising a Series A at whatever valuation. You'd say, okay, yeah, well, we're going to value ourselves at 20 times annual run rate for these and these reasons. But there's a number, there are real numbers, there's a tangible number, and we're multiplying it by another number. We can negotiate on what the multiplier is. It could be 5, could be 15, could be 20, but there's a base, there's a real number base out of which and it is real revenue that the company's already collecting and generating, right? We already, of course, have a much better idea of what the market is because the company's launched. We already know who the customer is, how many of those customers are there. There's a lot of answers that we've gotten after we hit $1 million in revenue. So it gets a lot easier to value a company at that point. But what about before that, right? What are these valuations based on? One argument that I see a lot is, well, do we base these valuations on forecasts? Do we just do a financial model? We can help with those, by the way, but you just do a financial model and just what the financial model says. This financial model says that we're going to make $2 billion in 5 years. And so because of that, our valuation is this. But remember, that's every company. Every company, type 2, is a $1 billion company. So that doesn't make you different. Why would you have a better valuation than the next guy that's also pitching this VC if you're also a $2 billion company? A $1 billion company type 2. Right? That doesn't make you different. It doesn't make you special. It doesn't give you a higher or lower valuation. Okay. So it's not forecasts. One other argument that we could use is growth, right? We could say that which company is growing, how fast are these companies growing? And that is very much a factor, right? If you remember, companies launch at between pre-seed and seed. So we could say, okay, like this company is growing really fast. They're doubling their customers every 3 months, right? So it's like 30% month-over-month growth or some crazy shit like that. That's valuable. That's valuable. That business is worth more because it proves that they've figured something out, that the customers want the product, and so on. A company that's growing slowly is worth less, right? And we maybe there's no multiplier tying to that, but that's definitely a number that influences valuations. But really, a factor that plays a lot, especially in the left side of this yellow bar, is FOMO, right? It's a lot of that is your capacity to go to an investor and tell them, hey, you need to invest in this business before it's too late. This business is so valuable, or it is going to be so much more valuable soon, that if you don't get in now, you're going to miss out. That's very much the argument, or the argument that makes a company more valuable. Their ability to convince investors about that. On the other side, let's remember that we've been talking about valuation, but again, valuation is a bridge between these two priorities, which is the payout. So we could even rephrase that to saying, hey, I need to invest in this business before my payout is too small, right? Too late for an investor is being like, if I invest too late, if I wait, my payout as an investor is going to get smaller and smaller and smaller, and that's not exciting anymore, right? So that's the FOMO that you have to play. But and again, like I said, a lot of valuations early stage work out of, again, the founder's capacity to get investors to outbid each other. I think that plays a big part. Um, and then there are also standards, I think. So I'm assuming that most of you guys are pre-seed and seed. Maybe there are a couple of Series A companies squeezing in the session, but I'd expect most of you guys to be here. And I can give you what the benchmark is, because we have it. We have the benchmark. The standard in 2025, the standard round of sorry, dramatic effect. In 2025, the standard pre-seed round was $900,000 at a $7.1 million valuation. That's what it was. This is from Carta. Yeah, those were valuations last year. That's it. That's median. So the median company raised money at this valuation. At seed, the median company raised $3.6 million at a $15 million valuation. That's the median, right? So you always want to know what the median is, because I don't have, this is, I think, a US benchmark, Andrea. I'm sorry. I didn't check. I think it's US. Yeah, so like you always want to know what the benchmark is, because you, of course, I mean, this is the median again, so that means that half of the companies raised at worse conditions than these, and half of the companies raised at better conditions than these. These are separate metrics, by the way. So the median round was 900 and the median valuation 7.1, but I'm assuming that they match. Yeah, but there are a lot of other factors at play here, right? So for example, if you operate in a very expensive city, right? If you're based in San Francisco, that company is inherently more valuable for a number of reasons. First, it needs more money. So, remember that you raise a pre-seed round to get to seed, right? So let's imagine this San Francisco company. Living in San Francisco is fucking expensive. You need to, $900,000 is probably not going to be enough, or maybe just enough to hire very few people. So you probably need to raise more, right? So maybe you're going to be on the higher end of that range, right? You probably need to raise something in the couple $1 million at pre-seed, because you need to spend it, right? But at the same time, because you raised $2 million, there's less risk with your business, because you have more runway, you can hire more talented people, and so on. So that raising more inherently makes the company a little bit more valuable. They're in San Francisco, but also there are more investors in San Francisco. So these founders have a better network. If they manage to raise $2 million, that means that the company is inherently more valuable, because the founders have a better network of investors that can fund it, or that can jump in again in the next round, right? Move that to the extreme opposite. I'm Costa Rican, so a company that's based in Latin America doesn't need that much money to get off the ground. There are fewer investors in Latin America, so I can't go. If I go and raise $900,000, that definitely be above the median for my region. So the answer is these companies raise less and their valuation is less, right? Another factor here at play is that there's a really established sort of standard as to like how much equity a round takes. Normally, each funding round investors are looking to get something like 20% of the round. And we're going to run some exercises on that. That's what we want to do next. Before I go to questions, I want to kind of go through a couple of exercises on funding just for you guys to see like how that operates in practice, right? In terms of valuations. And then it's only 30 minutes, so that's going to take me like 5 minutes. And then we'll just jump to all your questions. So for you guys on Zoom, I see a couple in the chat. Maybe if you wanna kind of sort them out a little bit, do you want to go to Q&A? There's a Q&A thing on Zoom, so you can throw your questions there, and that way I can sort them out and we don't get lost in the chat. For you guys on YouTube, on the YouTube live stream, we don't have the equivalent of that, but don't worry, we'll get to it. Just avoid throwing questions now because maybe we'll lose them. So we'll wait until I'm almost done with this little demo. Okay, so I'm going to use our own cap table tool because we have one, and it's Slidebean. So that way I get to demo how this works. Yeah, so in every Slidebean account, you can sign up. My team will paste the link, by the way. We have links on our cap table tool, so we'll throw them in both chats if you want. Maybe I'll give you that QR code back in a sec if you need it. But yeah, let's see a cap table and see how it looks. Okay, so I had done this with Anthony. I'd done this example with Anthony, but let's go to the founders first and set up ourselves. I see. I don't know who's going to be my co-founder. Jordan. I'm going to say Jordan as my co-founder. Right. So normally when a company gets established, normally gets established with about 10 million shares. At a certain price per share, that's just the standard, right? Let's assume that we don't have any money or anything, and we just set up this business as a empty shell, right? So each of us get 5 million shares. Normally, what you would want to do with founders is agree on a vesting schedule, right? So we want to say, okay, like we're gonna vest these shares over 4 years, and there's not going to be any cliff. That means that every month we'll vest, 1/48th of all the shares that each of us get. And yeah, we're going to expand that over the years. That's just the basic set of shares. I'm going to set this to, sorry, this is in Spanish. Let's say that we establish this in my bad, this is January 2026. Okay. That's just the base, right, founders? Now let's go to funding rounds. Now I'm going to sear this out. So the way you set up a funding round here is, let's say that we're going to work out of the pre-seed for now, right? And I'm going to use the benchmark that we used before. So there's a pre-seed round. The funding amount is $900,000. The round type, this is an equity round. Yeah, by the way, the 10 million shares in a cap table is standard. It makes it's easy so that, because you can't split a share in half, right? So when you have 10 million shares, it's a number that's easy to divide, because you have plenty of shares. If you just do it with 10 shares, you might end up at a point where the ideal number is like owning 10.3 shares, and you can't split a share, right? So that's why you normally do 1 million or 10 million shares. If you have 3 founders, you might do 9 million shares and give each one of them 3 million. So you're starting at least with round numbers. Okay, so now we're going to do this, and we're going to set the close date of this round to 2026. Right, so February, right? So this company got started, and it raised this pre-seed round in 2026. So let's look at a cap table and see what happened, right? So here, Jordan and I have 5 million shares. And then what happened is that we raised this pre-seed round at this valuation that we set out here, which is 7.1, which was the median that we used. And that's how our cap table is looking, right? So one interesting thing here is, and the founders get confused about this a lot, which is we both still have 5 million shares, right? We haven't sold any shares to these pre-seed investors. What actually happened is that the company issued new shares to the investors, and now we have 11 million shares. That's what always happens with C corporations in the US. It's not a reissuing of equity. It's not that you're giving or selling shares. If actually we sold some of our shares to an investor, we'd be in a little bit of trouble, because we've essentially taken an asset, sold it to someone, which is a dividend, and that's a taxable event. So we'd have to pay taxes to raise money, and nobody wants that. So what we would want to do is definitely create new shares for the company, right? So the investors are buying these shares at a certain price. Right? The price per share that the investors paid is 71 cents, if you wanted that reference. Okay. So now let's do but now before we raise a seed, or before even we raise this pre-seed, there's something that investors are going to tell us to do. Um, they're going to say, okay, right, we'll give you the money, right? We'll give you the $900,000, but I want you guys. But why are you going to give it to your employees? You're just these two guys. It's just me. It's just me and Jordan. But you're going to have employees, and are you going to give them equity in the company? I mean, you should. These are your very early employees, employee number three, or employee number one, if you will. You want them committed. You want to give them shares. So you'll have to create a stock option pool, right? So here in settings, we can do that too. This is stock option pool. This is stock option plan. And this is just a pool of shares that we'll create. Maybe we'll create 1 million shares as a pool. And we'll create, and one thing that investors will absolutely demand is that your pool is created before they invest, right? They don't want to have to give out of their own equity to the pool. So they'll want you to sign a stock option pool before they invest, right? So the way that works in the cap table is that you create this stock option plan of 1 million shares. That's 8% of the company. This is actually a small plan. For these early employees, you might need a little bit of a few. Oh, sorry. We'll need a few more shares. We probably want to go to the 1.5 million. So this is 11%. This is 11% of the company that we've sort of set aside and said, yeah, we're going to give this to employees. We haven't assigned it yet. That's a pool of shares that will exist in the business while and we'll decide, right? And this our cap table actually lets you create stock option plans. So we might add, I don't know, Viren. I see you have a question, Viren. We'll get to you. We'll pick a stock option plan here, and we'll issue some shares to Viren, maybe 100,000 shares. We'll grant those shares in 2026 as we hire them, or maybe later, right? Maybe we'll grant them in May. Doesn't matter. There will be a vesting schedule for those shares. If we go to the cap table, again, this is coming out of this pool. We can see it here in detail, right? Where we have Viren now owns a little bit of the company from that stock option pool, but then the rest of the pool is still unallocated, right? We'll have to assign it to someone. But the point is, investors will want you to create this pool before their money comes in. Now let's do the next round. Right now we're doing the seed. We set that the median seed was 3.6 million. So let's set that. The median valuation was 15 million. This is going to close maybe a year later, so 2027 after we reach those milestones. You can set the type of share, but I'm not getting into that today. We have a little bit of a price per share situation here, but also, again, these investors will also want you to create a pool, another stock option plan. This is going to be stock option plan number 2, right? You're going to create this one. It's maybe a couple million shares this time. And you'll want to create this one again before that investor capital comes in because they don't want to dilute themselves with the stock option plan. And then we go to the cap table. So see what's happening here. We've both of us, again, Jordan and I still have $5 million, 5 million shares. The pre-seed investors, they got diluted a little bit. Remember, if we look back, these guys had something like 10%, 11% when they first came in. But now we have the seed people, and now we created a stock option plan after their investment, right? So stock option plan 2 diluted them a little bit. And now, again, the number of shares that everybody owns is the same, except the company now has more shares. Funny enough, and this is no, it didn't add up exactly, but if you remember that we said that by Series A, like the company had about 56%. Well, both of us founders now own 54% of this business at seed, right? It's below the median, I think. No, it's around the median, the median that we used. Let me find the slide. I think we nailed it. It's a little bit of a coincidence, a little bit of mathematical match. Here it is, right? The median priced seed company owns 56%. So we're actually pretty close. This is maybe not too different from what a company might operate in, right? If we go to, if we add another round here if we add another funding round for seed and valuation and so on, we'll continue to see how that operates. So of course, the reason I show you that is a little bit to kind of show you like how this stuff works in practice, right? So let me give you the link once again as to where you can grab it. You can snatch that QR code there, or again, my team. I don't know if my team has pasted the links. Team paste the links to the cap table. Otherwise, you can just head out to that QR code cap table URL thing. Okay. So next up is so next up is questions, but I have a couple of commercials first, which is again what you've seen is just one of the tools, the cap table tool in our Slibean platform. Slibean does a bunch of other things. We have an AI pitch deck builder. We have an AI pitch deck reviewer that has been very popular lately. We have all these webinars that we do every month. We have we have a financial modeling tool as well. A bunch of presentation templates, pitch deck templates, and a few other. Oh, and Investor Finder is probably the last thing I'll mention. We have like a database of over 20,000 investors, so that you don't have to go and Google who might invest in your company. You can filter them out. And then one of our subscriptions, Accelerate. It's not the only one, but we have different plans depending on what you need. But Accelerate, which is our most popular plan, includes one-on-ones with my team. So we do you get one call a month with our pitch deck team. You get one call a month with our financials team to go over your financials. So either review your deck on a 30-minute one-on-one session, or review your financials, or help you build your financials in those 30-minute sessions. We have a full-on boot camp that gets included with that. And you also get a couple of strategy calls with me. The first one is usually a group call, small group call, where we go through questions, a little bit what we're going to do now, but with a much smaller group. I think we have, how many people do we have? 85, over 100 people today. Wow. Thank you for tuning in. So a smaller group, usually 5 people. And we can do a Q&A, and then we do a one-on-one as well. After you've gone through a few rounds of revisions on the pitch deck and so on, I always like to jump back into with the founders and go over their fundraising plans and how they're going to pitch investors, or maybe discuss a little bit of valuation now that you understand this stuff better. So that's all my slides. Let me jump to questions now. I'll start with you guys on Zoom, and let me move this here so we have so I can better see. Oh, damn it, I lost my Zoom thing. Okay. Oh my God. Sorry. Just kind of rearranging my desktop here. Okay, got it. All right, I'll take Hector. Can you talk on what a 409A valuation is? Good question. In the US, a 409A valuation is an official valuation of the business by think of it as an appraisal of the business, if you will. So basically, some accountant goes into your numbers and checks and sees, okay, like this company has these assets. It's mostly based on assets, right? It has these assets, it has this team, and it's received this amount of capital, and we're going to say that this company is worth this much. The 409A you do not use for fundraising. You do not use as an argument against investors to say that you're worth more, not in the early stages, because it's not based on speculation. It's not based on forecasts, or at least not a lot. It's just more like a formal appraisal that you need to do for some legal paperwork. Your stock option pool needs a little bit of an input from a 409A. That's what it's for. What's your take on the space of tech startups and growth in the next 10 years? Oh man, that's such a philosophical question. Honestly, my hottest take on this, maybe, I don't know if you were looking for the hot take, but I'll give you the hot take. I think that SaaS companies are going to go through this weird transformation over the next few years, because I like to compare that to e-commerce, right? And company 1 and 2, right? If you started an e-commerce in the 90s, you would be a company 2, right? You needed to start, you need to create your own server farm and buy your own servers and hardware and build this big team and raise a lot of money. But when Shopify came in, or whatever e-commerce tools came in, that was not the case anymore. Right now, an e-commerce is something you can build out of your garage, and you don't need venture capital to do that. You don't need a lot of money to do that. I have a feeling, and I don't know for sure, but I have a feeling that a lot of SaaS companies are going to starting a SaaS company is going to get a lot easier than it was. Like, it's already easier because you have AWS, right? You need to create your own servers, but you still need to raise money for it. You still need a lot of developers to do it. But I think that as AI gets better at coding and building prototypes, I think that early stages of funding or early stages of a company are going to be cheaper. Maybe founders will figure out that they can skip them, because it gets a lot easier with, we call it vibe coding now, but I think that, imagine where that's going to be in 2-3 years. I think that you'll be able to build easy prototypes in no time compared to now. Now if you need to build a software prototype, you need to quit your job and spend 6 months on it. But those timelines are getting a lot shorter. I think that that's going to change the way startups work and get funded in a lot of ways. Some good, some bad. Edgar, do you have any idea about the possible average of pre-seed and seed funding rounds in Latin America? I don't. I know that it's less than the States, but I don't know if anybody's done any studies on that. I don't have any data points top of my head. Khalil, any idea if you're in the Middle East, MENA region and can't follow US metrics, how do you should go about valuation caps? Um, yeah, I think that I think that you should establish that in the US, that's usually where you get the best valuations, right? There's more money, there's more VC, people are more willing to take risks, there are more companies happening. Right. The US is normally where companies rate at better valuations. In Europe, if investors aren't that speculative about valuations, about fundraising. Um, so like they usually don't pay those big multipliers or they want more equity, right? They want that balance to be bigger in Europe. And I think MENA is a little bit in between the two, as far as I've seen with other founders and other companies that I've met that have given me a little of their that have given me a glimpse into their cap tables. I feel that there is enough capital in the Middle East and there's some speculation in the Middle East where you kind of operate better valuations than Europe, worse than the US is what I've seen. But this is I don't have any numbers on that either. Um, Bill, I have an account and enjoy the service. After updating the cap table on the site, is it possible to export to Excel so I can share the tables with partners? No, it isn't. We have a system where we update the features on the cap tables. We don't look at the numbers, but we push updates. Even though they're spreadsheets, we push updates internally, so we don't allow exports of the cap table. I'm sorry. You can do a screenshot, and again, yeah, you can do a screenshot. That's usually what you need. You don't need to give them edit access. And if you do, you can just invite them to your account. Adding seats to your account is free, so you don't need to pay an extra seat. We're in the process of converting from LLC to C Corp, and we are defining the initial cap table as 10 million shares, 7 million for founders, 3 million reserved for stock pool and special interest. That's good. Should we wait to define the pool until our pre-seed begins? No, I think you can do that. It's a big pool. Great for your team. Again, just know that the equity that goes to your investors, because you're going to create new shares for them, is not going to come out of the pool, right? It's going to be new shares issued, which is going to dilute everybody down the line. But yeah, that looks fair, and I don't think you need to wait for the pre-seed conversation. You can just set it. Where do you get a copy of the slides? You don't. These are mine, my precious. No, just on the Startup Club channel on YouTube, just look for Startup Club or Startup Club by Slidebean. You'll find a recording of today. You make a hard distinction between type 1 and type. This is the last one. I'll start taking questions from YouTube too. Sorry, guys. I'll jump to YouTube and then back to Zoom. You have a hard distinction between type 1 and type 2 companies. Isn't there an actual gradient between the two, and how might you adjust for a company that sits in the scale of 1 to 2? That's a nice question. I think yes, I think there are middle grounds, but I think you have to envision who you are. More than the moment you're in the middle, you start to, you can be somewhere in the middle, I guess, but the moment you're in the middle, it starts to get blurry as to which investor invests in you and at which valuation, to keep it in the topic of today, right? So these type 2 companies is what we discussed. These type 2 companies, they can raise 900 at a $7 million valuation. They can go to VCs. They're expected to go through multiple rounds of funding. That's a black and white 1 or 0, yes or no sort of situation, right? Are you envisioning multiple rounds of funding to unicorn path? Yes, no. That's a yes, no question, I think. The moment you start kind of getting into stuff that's less scalable, or markets that are more saturated or less or less based in tech, maybe working with maybe you need humans to scale your business. Yeah, maybe there are humans in your costs, right? In the sense that you're manufacturing or you're in the food industry, or I don't know. The moment you do that, like you start to become company 1, and I think that again, I don't think that there are gradients, but small, right? You can be a 1.9 or a 1.1 type of company, but and that, gives you an edge. If you're 1.1, if you will, just to use that metaphor, you're a better type one company, right? You might um, get a little bit of a better valuation in that world. Or on the other hand, right, if you're a type 1.9, like you're a little bit you're doing something that's traditional or like non-techy, so you kind of lose a little bit of valuation because you're skewing towards the middle. But I think investors have a very hard line. It's like, we do not invest in type one companies, period. And that's the case for most VCs or tech VCs. Okay, questions for YouTube. Sorry, guys. I want to take some from here. Okay. What is a healthy raise and valuation for pre-seed? I think we talked about that. In fintech, how would you value a good pre-seed round? I think we talked about that. I think that it's no difference on fintech versus others. I think it's a standard. That report by Carta, I think, gives you a little bit of an insight, but I don't think it makes a big distinction on industry. I think they all kind of fall within the same range as long as they're company two, right? How should we go about valuing a SaaS startup that has built a product ready to grow, but hasn't yet invested in marketing and growth? So there's little revenue. Oh yeah, I love that question. Yeah, I need slides for this. Hold on, I got to show you. This company that Easy Clean App, or like maybe that's the name of the company. Easy Clean App. Easy Clean App is here in this journey, and I think it's important to talk about it. I think it's useful for everyone. Again, we've established the potential, right? So, but I think that the problem with Easy Clean App is that they're here. They are here in this chart. We've established that seed companies have revenue and they're growing 20-30% a month. Normally a seed company has 40,000 in revenue, especially SaaS, 40K in MRR. That'd be a seed benchmark. So you are not a seed company. There's no middle ground here. You're not a seed company yet. In that case, you're a pre-seed company. I think the challenge, a lot of the challenge that software companies face when they're between these two realms is that you can get stuck here in the middle because we established a lot of investment happens around FOMO, right? So when you're a pre-seed company, you can play the FOMO card around, we're going to be huge. There's a huge idea. We're an insane team. Invest now or you'll miss out, right? And when you're a seed company, you can FOMO the investors around the lines of, oh, we're growing really, really fast and our valuation is increasing every month. So you might as well give us your money now and lock in your investment so that you can get a good payout. But when you're here in the middle of these two, you're a little bit in a catch-22 situation because there's not a lot of FOMO that you can play, right? If you have a product that's ready, that's what you're saying, right? We have a product that's ready to grow, but there's no marketing investment. And you go and you pitch that to me. Imagine I were an investor. You pitch that to me. What would else say? I'll say, okay, I'm excited. Let's talk in 3 weeks. Maybe I'm busy. Maybe I'm intentionally stalling. Why? Because if your product is ready to grow and you're working on this, 3 weeks from now, we should see that growth. So there's no FOMO for me because the answer to the predicament of how big your company is gonna grow is an answer I can get in 3 weeks. So I can stall. So negotiating between here is when you have a product that's ready but there's no data around it is very complicated. I would just rather play the pre-seed card and go and go that path until you have the metrics for seed. You're a pre-seed company, right? But again, that FOMO changes in the way you can play it, leverage it. Abdullah, I'm planning to raise 800K for a pre-seed round for a tech startup. Could you please tell me the strategy and how much that valuation would be? I think we covered it. I just rewind a little bit if you missed it. I see your question about the board. We have a couple of videos about the board decisions here in the channel, by the way. You should check them out. Just look for board. And the Slide Bean channel, we have a couple too. Younger version of me. Would you do a video about alternative ways we can retain control like Zuck? Man, none of us are Zuck. We have to accept that reality. That's it's a 1 in a million case. So I wouldn't use that as a benchmark. I think it's Okay. Whoa, man, so many questions. I do have to run at the hour, but I'll try to get to as many as I can. I'll spitball quickly. What about the friends and family round? Because it has been almost standard for pre-seed. You need revenue, product, and traction. No, friends and family round is pre-seed round. I think it's the same. I mean, today in this day and age, it's the same thing. Seed is revenue. Pre-seed is not just idea, but idea plus. Um, Stock option pools. Can you talk about the philosophy around issuing to early employees? It feels like you should really do yourself damage. You could do yourself damage if you do this inappropriately. Yes, you can do damage if you do this inappropriately, absolutely. But I think the thing with early employees is, why would I want to work with for your company if you're gonna pay me bad because you're a startup and you have a lot of money, and uh, there's a good chance you'll fire me because you run out of money. There's a lot of risk with working for an early stage startup. The earlier, the riskier. So how are you going to compensate for that? You don't want to compensate for that with money because you don't have a lot of money, and you don't want to reduce your runway because that makes your company riskier. So how do you compensate for that with equity? I think that's the logic of stock option pools. Um, I mean, maybe you can hire people that are not aware of this, especially outside the States. Stock option pools are not so much of a standard, but now that I've worked in this world, if somebody, if I'm applying to a startup for work, I'd expect stock options. And I think good employees that are experienced in startups will. Um, how should we think about valuing a SaaS startup that has built a product? Oh, I think we've covered this. Yeah. It'll be a Delaware C Corp owning operations in MENA. Doesn't matter. Your valuation depends on where your company's based, not where you registered it. So where your team is based, where your market is, that's where you are operating essentially. The fact that you incorporate in Delaware doesn't make a big difference. What are your views on esports? Also the XR training for medical sector. I love gaming. I don't watch esports, so I don't have a lot of opinions on that. XR training for medical. I've seen a lot of companies doing that. A lot of companies doing that. I don't know. I'm not that familiar with the space, but I've seen a fair share. Um, as a startup builds, launches, and takes off, do I understand that you may have to start as company one and morph into company two? Is that decision made for you as you grow? No, I don't think it is. And it's a good question. I think you choose to be a company one or you choose to be a company two. And that's what you strive for. That's the type of product you build, the type of investor that you look for, the type of team that you assemble, even the type of company. Like company one could be an LLC and that'd be fine. But a company two has to be a C corp, right? You have to decide who you are early on and commit to that. Sometimes things don't work out, right? Sometimes company two doesn't work out and becomes company one. I think today we're a company one, but we didn't set out to do that. We sort of we got stuck between rounds of funding, and sorry for another day, but we ended up being in company one, and now that's where we are, and we operate like that. But that wasn't the plan, right? So I think you should plan for one, and I think another founder, and that's an important question. Another founder, or most founders, if they have a company two and they realize that they're not going to raise the next round, or that they're not going to be a company two anymore, they might just say, okay, like I'm going to do something else, and that'd be perfectly fair, and investors wouldn't complain, right? Because their investors wanted a company two, and if it's not a company two anymore, then it's not interesting. I mean, we're still around because we really enjoy doing what we're doing, and we're not a bad company one ourselves, but we are, and that's that. And I'm giving you this personal story so that to enhance the fact that you can't switch sides. You're one or the other, and you should commit to what you decide to be. Also, we got it easy from investors when we switched, but most investors won't like it. Moving from company one to company two is, I guess, easier, but I mean easier in the sense that everybody wants to be. I mean, everybody wants more money. Everyone wants a bigger payout. Um, but not all company one products or solutions can become company two. Can you share what the average multiple is for valuation in a cybersecurity company? No, I don't know the exact numbers, but I wouldn't expect them to be very different from the rest of the market, honestly. Right, guys, I do have to run. Maybe no, I do have to run. Yeah, sorry. Okay. So last commercial again. If you have more questions, sorry I couldn't get to all of you. Thanks a lot for tuning in. We are doing sessions every week, so there's another one next Thursday. I think next Thursday's session is called How to Raise an Early Stage Round. It talks a lot more about the milestones and what you need to do. So like it's going to be useful. We have one on financial modeling coming too, on how to forecast your growth. Um, yeah, a couple more on early growth and marketing. So just check out for the schedule wherever you found this one. You'll see the schedule for the next ones coming up either on the club channel or on Slidebean or on our newsletter. I don't know where you guys found out about this, but thanks for tuning in. See you next Thursday. Bye.